Is it just me, or are the calls for a big market crash getting louder and louder? Heck, Michael Burry's short Nvidia, man, it's all gonna go to zero. Whether it's Bitcoin is topped or a 75% crash is coming, the AI bubble's gonna burst, markets are gonna crash, the economy's worse than during the 2008 financial crisis, doom and gloom headlines everywhere right now. If you're yet to experience a market crash, you likely won't see it coming and you'll be blindsided by it. It's a slow grind up and an elevator down every time. But if you've been investing long enough, you'll know the worst crashes don't magically appear out of nowhere. There's always signs. They slowly creep up on you. You tell yourself the signs don't matter, but they do matter. And only those who are paying attention will be able to spot the signs and prepare for it. So let's dig into the red flags that have shown up time and time again before a big market crash. And most importantly, find out if those red flags are like giant flashing indicators right now saying, get the fuck out of the markets. First up, let's talk about the classic crash signals that you always hear about. And yes, they still matter, but they're also misunderstood. Labor market weakness shows up historically right before a major economic downturn. Jobs slow, layoffs rise, consumer sentiment collapses. If people aren't getting paid, they won't be spending. The dominoes begin to fall. And guess what? We are seeing some weakness in the labor market right now. Part of it's due to AI stuff, part of it's due to low interest rate regime unwinding, all that kind of stuff, but it's not in free fall yet, even though the cracks are there. US job cuts hit a 22-year high, the highest for any October since 2003. Consumer sentiment fell this month to the lowest level since June 2022, and the unemployment rate is currently 4.3%, which historically is still on the pretty much lower side of unemployment. But fears it could have risen to a 4-year high in October are definitely making markets a little bit concerned. Corporate earnings will also fall when companies start missing their earnings forecasts. Investors begin to panic that the economy is slowing down, but thankfully, again, none of this has happened yet. People are fearing that it's going to happen, so we have to keep watching these things. Out of 91% of companies reporting their Q3 results so far, 82% have beaten their earnings estimates. Wall Street's on fire, in a good way. Valuations are keeping pace with earnings. Until this changes, Wall Street says the party isn't done. Then there's the obvious indicator. The technical definition of a recession is 2 consecutive quarters of negative GDP. And I know the Biden era changed this. It doesn't matter anymore, but technically that's what you watch for. The problem with this is, as a recession indicator, is that's a lagging indicator, of course. By the time a recession is called, you're already 6 months into it. Thankfully for the US economy, it's still growing at 3.8% as of Q2, and a slight setback in Q1, but didn't really make much difference. The Fed now forecast is projecting a 4% GDP growth for Q3. That is an absolutely on fire economy. You do not see this in major economies like the USA. Then there's a signal that investors don't always agree on. Rate cuts are often viewed as this tool that central banks use to play damage control, confirming recessions already hit the economy. But I don't want to say this time is different, but people are not taking the correct historical context, because actually this time is the same as the 1990. According to legendary investor Ray Dalio, he says this time the Fed is stimulating to a bubble, because on top of cutting rates, the Fed will be ending its QT program from December 1st. That signals liquidity is coming from everywhere possible. While some classic warning signs are flashing red, or at least warming up a little bit, others may not even have fired yet. That means we're in a watch mode. Watch for labor market weakness, for example. Watch for big changes from the Fed. But currently they're easing, not tightening. So we're not in a panic mode. Now let's talk about what the stock market is telling us. But before we get into that, guys, if you're new to crypto, or maybe you're already trading crypto like a pro, it doesn't matter. Either way, you are a target. Hackers, scams, restricted access everywhere. But it doesn't have to be like this. You see, crypto isn't as anonymous as you might like to think. Your IP address can be traced. Every transaction is public. Fake exchanges, malicious wallet links, everything's designed to steal your hard-earned money, as if this game wasn't hard enough as it is. One careless click, wipe out everything. That's where NORDVPN, the sponsor of today's videos, comes in. It's not just a VPN, it's your crypto armor. NORDVPN encrypts your connection, hides your IP, protects your data. Its threat protection blocks malicious sites, scans for malware, and now with Threat Protection Pro, the new crypto wallet address checker even warns you before you send to a risky address. So don't wait for disaster, okay? Take action, secure your crypto and your privacy today with NORDVPN. Use my exclusive link right down here, and for the price of a coffee each month, you're gonna get real protection and complete online freedom. Act now. Check it out. Okay, so what's the stock market telling us about the markets right now? Company valuations are coming off record highs. NVIDIA became the first company in the world to reach a $5 trillion market cap, which is absurd beyond belief. It went from $500 billion to $5 trillion in just 2.5 years, which is crazy. But high valuations don't guarantee a crash. They just raise the stakes. Earnings could continue to surprise. Interest rates could fall. They're scheduled to. Growth can keep accelerating. It's scheduled to. Financial conditions are getting looser, not tighter. All of which can support elevated valuations for longer than people might like to think. Despite these all-time highs, the markets are anything but euphoric. In fact, anytime the stock markets move down 1%, everybody loses their fucking minds. Sure, some sectors of the stock market might be showing some froth, like tech, right? Tech and growth stocks have led the rally. So I can understand people are, wow, there's too much concentration in that, but overall sentiment is sending a very different signal. If you look at the fear and greed index for stocks and crypto, they're both showing fear. People are terrified of any tiny little move in the market. So investors aren't blindly bullish, they're cautious. This is not market top behavior, okay? People are wildly bullish and losing their minds to euphoria when we reach a real top. We are climbing the wall of worry. And it's a subtle but critical point. High prices alone don't equal euphoria. For a classic crash setup, you need frothy prices and widespread blind optimism of people getting rich who don't deserve to get rich because they're not normal market participants and they got rich randomly by options trading or buying a fucking meme coin or something. We've got the froth, but the crowd is still hedging its bets. Then there's, of course, the Hindenburg omen, which is a technical warning signal that looks for internal market instability. It shows that when a high number of stocks hit both 52-week highs and 52-week lows at the same time while the overall market is still in an uptrend, that's a warning sign. It's a red flag. Historically, when this happens, it can precede a market correction or a crash, though it's not guaranteed. Think of it like the market whispering in your ear. Something's off beneath the surface. There's too much concentration in one area, even if the headline numbers look fine. Right now, it is flashing red on the S&P 500, but this is largely due to how much large cap stocks have risen by. But something that could tell us what's going to happen next is the business cycle. I know I talk about it all the time, but it's really important because market tops top with the business cycle, not when the business cycle looks like it does currently. So for this, we need to look at the ISM Manufacturing PMI. It's a survey that measures business activity and is therefore a leading indicator of economic activity because manufacturers react very quickly to changes in demand. Right now, it's showing a score of around 49, which may surprise a lot of investors because what it is showing is that the expansion phase is still yet to even begin. We have such a delayed cycle right now because of all the manipulations that went on during the COVID regime and the monetary policies that followed. This all signals new all-time highs are likely still coming for stocks and crypto. Yes, we've volatility along the way. There always is. Prepare for it. Be ready for it. Embrace it. But every time Bitcoin is topped out, it's also coincided with the top of the business cycle when the ISM PMI is like 60 or 65, not at 49. Okay? That to me looks like the bull market, as crazy as it is to say, has barely gotten started yet. At least the major phase that we like to think of as being the bull market. I've been in a bull market for a few years now, but the big phase, right? But now it's time for the big question. Is a crash coming soon or are we still coasting to new all-time highs? Well, the honest answer is yes, a crash will happen at some point. They always do. Expect them. Embrace them. Be ready for them with cash on the sidelines to buy your favorite shit at giant discounts. But that doesn't mean it'll happen tomorrow. In fact, from what we're seeing right now, likely we're a year or two away. Okay? Market crashes don't happen just because of one bad headline. They build slowly beneath the surface. Cracks will start to appear. As more cracks start to appear, fear rises. And there's a few cracks, like the labor market right now. Inflation has been going up in the wrong direction, but it hasn't been spiking dramatically. If the Fed were to change course and start doing rate hikes instead of rate cuts, holy shit, that would be crazy. We're not there yet. We have the opposite. QT's ending, rate cuts are coming, all this kind of stuff. And this is where cognitive dissonance can really mess with you. While there are some warning signs flashing, markets have so far continued to climb the wall of worry to new all-time highs, and your brain struggles to reconcile these two ideas. It can shake you out of positions. It can make you FOMO in and lose sight of your long-term goals. If you want real market updates, by the way, to help you navigate these crazy market cycles and prepare for the next crash, by the way, you need to sign up for our free newsletter. It's awesome. Crypto, macro, stocks, trade setups, and more. It's free, link down below. Go check it out. So now is the time to focus on the things you can control, okay? So stick to your strategy until proven wrong. Keep watching the macro. It's the big signal. Manage your risk and don't let short-term noise mess up your plan. I know fear has been high in the markets recently, but a lot of that fear has been unwarranted. Okay, so use the signals covered here as a guide, not a trigger to act impulsively. Inform yourself as best as you can. Educate yourself as best as you can what these indicators are, why they matter, and why you should be watching them to see when the markets are running out of steam or not. Thanks for watching.